In just 6 months, the US dollar lost nearly 11% of its value, its steepest first-half decline in over 50 years. By the year's end, the euro surged up to 15%. Moody stripped America of its last elite credit rating, gross domestic product projections plunged, and Wall Street giants now warn the worst may not be over, only paused. If the world's dominant currency can unravel this quickly, what triggered such a dramatic loss of trust, and how much further could the dollar fall? The numbers behind the dollar's 2025 decline read like a warning siren. The dollar index, which tracks the greenback against a basket of major currencies, plunged from 103.9 at the start of January to 92.7 by the end of June, an 11% drop in just 6 months, the sharpest first-half decline since the oil shocks of the early 1970s. The euro surged in response, climbing from $1.10 to $1.24, a gain of more than 13% and its strongest run in nearly a decade. By December, the euro's advantage widened further, with year-end figures showing a 15% appreciation over the dollar. The world's largest credit agencies responded in kind. On May 16th, Moody's downgraded the United States from its last top-tier AAA rating to AA1, citing an excessive debt burden and political gridlock. This left the United States without a single AAA rating from any of the major agencies for the first time in history. The market's response was swift. Morgan Stanley's mid-year forecast warned of a pause, not a recovery, as United States GDP projections for 2025 were slashed to 2% by the IMF and to as low as 1.4% by the Congressional Budget Office. Wall Street analysts flagged a deceleration in consumer spending and a spike in borrowing costs, with the S&P 500 and Treasury markets both under pressure. These figures are not just statistics. They signal a sudden loss of confidence in the dollar's reliability. The world's reserve currency, once a symbol of stability, now faces a level of scrutiny and doubt not seen in generations. April 2025 brought a wave of decisions that rattled global markets and sent the dollar into its steepest slide in decades. The White House unveiled a sweeping tariff package, quickly dubbed Liberation Day by officials, targeting imports from major trading partners. Within 30 minutes of the announcement, the S&P 500 lost over 2% of its value, with more than $1 trillion in market capitalization erased before midday. Investors scrambled to unload dollar assets, driving the dollar index down another 0.6% by the close. Internal Treasury memos later released through FOIA warned that the policy could wipe out as much as $5 trillion from U.S. equities by the year's end, with technology and automotive supply chains singled out as especially vulnerable. The market's anxiety deepened in May 2025 when news leaked of a draft memorandum from the White House Legislative Office, outlining a plan to remove Federal Reserve Chair Jerome Powell if he refused to ease monetary policy in the face of a tariff-induced slowdown. The mere hint of political interference sent the dollar tumbling 0.8% in a single session, as traders questioned the central bank's independence. For the first time in a generation. Meanwhile, a debt-heavy bill nicknamed One Big Beautiful Bill cleared Congress, adding more than $4 trillion to federal outlays over the coming decade. The fight over its passage triggered a 58-day government shutdown, the longest on record. According to the Joint Committee on Taxation, the shutdown alone cost the economy $1.2 trillion in lost productivity and $250 billion in extra borrowing costs. Each of these shocks, tariffs, threats to the Fed, unchecked spending, and a paralyzed government, combined to shake faith in the dollar's future, turning what might have been a temporary correction into a full-blown crisis of confidence. A single dollar once carried real weight, enough in 1913 to buy a dozen loaves of bread or 10 bottles of beer. Over the next century, that buying power slipped away almost unnoticed, eroded by steady inflation and a series of policy choices that shaped the modern economy. Since the Federal Reserve's creation in 1913, the dollar has lost about 96% of its purchasing power. What cost $1 then now costs over $25. The story is written in the numbers. The Consumer Price Index, set at 100 in 1913, now hovers above 300. A dollar that bought a full meal then barely covers a small coffee today. Major turning points left deep marks. The Bretton Woods Agreement of 1944 made the dollar the world's anchor, tying it to gold at $35 an ounce. That promise lasted until 1971, when President Nixon ended gold convertibility and set the dollar free to float. Without the gold anchor, the money supply grew rapidly. M2, the broad measure of dollars in circulation, has multiplied more than 30-fold since that break. The result is prices that climb, savings that lose value, and a currency that, over time, quietly slips from the foundation it once claimed. Even in recent years, the pace has quickened. The 2021 to 2022 inflation shock wiped out 7.4% of the dollar's value in just 12 months, the steepest drop since the early 1980s. These are not distant events. They are part of a long, relentless pattern, leaving the dollar more vulnerable to today's policy shocks and market doubts. The federal debt now towers above $36 trillion, equal to 122% of the entire U.S. economy. In 2025 alone, the Treasury added $1 trillion of new debt every 100 days, a pace that even seasoned analysts once dismissed as unthinkable. Congressional Budget Office projections show the debt-to-GDP ratio climbing to 118.5% within a decade, and if current trends hold, that figure could reach 155% by 2035. The real squeeze comes from interest payments. The government paid over $2.5 trillion in interest this year, a sum larger than the entire defense budget. If interest rates rise just 1 percentage point, annual costs balloon by hundreds of billions more. Each new borrowing round deepens the cycle. Higher debt pushes up rates, which drives up interest costs, forcing even more borrowing. Treasury officials warn that by the end of the decade, interest alone could consume nearly $1 in every $10 spent by the federal government. As creditors watch this spiral, their willingness to hold dollars is no longer a given. Central banks and global investors are quietly reducing their reliance on the dollar. IMF data shows the dollar's share of official reserves has fallen from 66% to 58% in 5 years, a generational low. BRICS countries are at the forefront. China cut $30 billion in U.S. treasuries in April, while Russia and India sold another $25 billion. Instead, these nations are buying gold, adding 1,045 metric tons to central bank reserves in 2024. Gold now makes up nearly 13% of BRICS reserves, twice what it was 5 years ago. Payment networks are shifting too. China's CIPS system handled $1.2 trillion in cross-border transactions this year, up 28%, as banks move away from SWIFT. In Europe, pension funds and asset managers have hedged $42 billion against dollar risk, quadrupling their exposure since 2020. U.S. equity ETF inflows have halved, while Europe-focused ETFs attracted $42 billion. JP Morgan warns another 30% could exit dollar-centric funds if trends continue. The world is quietly diversifying step by step. Imported goods now arrive with a higher price tag. The Bureau of Labor Statistics reports the import price index climbed 4.2% in 2025, the biggest jump since the last inflation spike. Electronics and apparel saw some of the fastest increases. Smartphones, laptops, and clothing all cost more as the dollar's value slipped. At Bright Tech, a mid-sized electronics importer in Los Angeles, the cost of microchips from Taiwan rose by $1.1 million in just a single shipment, wiping out nearly 8% of annual profit. The company passed some of that on to consumers, raising prices by 4% and warning of further hikes if the dollar keeps falling. Travelers felt the squeeze too. The average AIR fare to Europe jumped 7% in the first half of the year, according to the U.S. Travel Association. A New York to London round trip now averages $1,450, up $200 from last year. Meanwhile, borrowing became riskier. Variable rate mortgages and credit card interest rates climbed as foreign investors demanded more to hold U.S. debt. But not everyone lost out. Heartland Steel, a Midwest exporter, saw revenues from European sales rise 12% as the stronger euro made American goods more attractive. Higher input costs for imported materials ate into those gains. For most American households, the dollar's decline means everyday life is simply more expensive, and the risk of deeper pain is growing. The fate of the world's leading currency has played out before, written in the slow unraveling of the British pound. In 1948, sterling accounted for more than half of global foreign exchange reserves, almost double the share of the United States dollar at the time. Britain's empire still spanned continents, and the pound was the default for trade, debt, and cross-border payments. But over the next 3 decades, a steady drip of crises, devaluations, lost wars, mounting debts, and the rise of American finance chipped away at that dominance. By 1969, the pound's reserve share had fallen to just 8%. By 1980, it was barely 2%, while the dollar soared past 60%. The pound's role as the world's invoice currency faded just as quickly, dropping from nearly 60% of export contracts in the late 1940s to less than 12% by 1980. Today, the dollar still writes over half the world's export invoices, powers 50% of SWIFT transactions, and underpins 70% of all foreign currency debt. But the pound story is a reminder even the world's anchor currency can lose its grip, not with a crash, but through a long visible erosion that only looks obvious in hindsight. This isn't collapse, it's erosion. The US now adds $1 trillion of debt every 100 days, while global reserves slip and alternatives quietly multiply. The reckoning isn't theoretical anymore. The real question isn't if, but whether we'll be ready when confidence finally cracks. Let me know your thoughts below.